Hey guys, welcome to the video. Today we're going to be talking about the top 6 stocks that I hold in my portfolio. If you haven't watched the prior 4 videos of me going through my portfolio and you're interested in any of the other names you see on your screen, be sure to check out my channel. I'll leave a couple of the links in the description of this video if you're interested. But today we're really going to be focusing on the top 6. One disclaimer I want to make before going into these top 6 stocks that I hold. The first one is my portfolio is very top heavy. So these top 6 stocks actually comprise of about 50% of my total portfolio. And then the second thing is just given the size of these holdings, at the top of my portfolio, lots of these stocks are really focused on long-term risk-adjusted returns over a very long period of time. So some of these may seem expensive stocks relative to their growth profiles, but have a great track record of providing long-term value and returning a lot of capital to shareholders, being very trusted businesses. So we'll talk about that a bit throughout this video. If you like this type of content, please consider subscribing to the channel. We're growing pretty fast. We've been at it for a month now at 26 subscribers. So let's try to get up to 30 subscribers. But I just want to thank everyone just for watching the videos, commenting, subscribing if you're enjoying the content. And yeah, we'll just get right into it here. Stock number 6 is McDonald's. So McDonald's, obviously very well known quick service restaurant brand, global footprint, has been around a long time. This company is very important to my portfolio because I feel like it's a very defensive business. It's diversified in a lot of different ways from a geographical standpoint, but also from a standpoint that as people and the economy maybe trends downwards, lots of people seek value, and McDonald's always prioritizes value relative to competition, no matter what is going on in the economy. So if we just take a quick look at the stock, that's probably one of the reasons it's done so well. You can kind of see past 1 year, we're up about 6%, plus we're paying about a 2.5% dividend. So the market's down 20%. We've gotten almost a 10% return on investment over the last year in McDonald's. The company is trading pretty rich. I have them at probably about a 27 times current earnings. So that's pretty rich in this market, especially with interest rates where they are. But I think they've really built a lot of trust of being a business that can compound during times of weak economic times or strong economic times. And it's a safe place to park money from an operational standpoint during tough times, and that's why it's held up so much. So it's not a company I'm adding more to right now, but it's definitely not one I'm planning on selling, and I'll be holding it for a very long time. Going a bit more into this business, so this is only up until 2020 when they last did their consumer fact sheets or investor fact sheets, but you can kind of see the pace of restaurant growth on this business. Something else to note is they've consistently been adjusting their business more and more into franchising. So they've been selling off stores that they own, at least the businesses, not the land underneath them, but selling off the locations that they own, and then taking back a royalty fee, and then also another fee as a percentage of revenue as the rent for the locations, and that's kind of their business model. So each one of these stores are kind of profit centers for them. So it's great to see restaurant growth because that's just increasing the pool of profits. It's also speaking to the popularity of the brand globally, as lots of this is expanding outside of the US. Going into some of the things that they're focusing on from a strategy point of view. Let's start on the left-hand side, maximizing the brand, maximizing the marketing. They call out affordability here. I'd say I've been a shareholder of McDonald's probably for 6 or 7 years now, probably. And no matter if the economy's booming, the economy's going downwards, they always highlight value and affordability on their earnings call and their presentations. So this isn't just like something they threw in because people are worried about the economy right now. They really live by providing value and affordability and winning with those consumers seeking those things, which never really goes out of style. The second one is committing to their core focus areas, burgers, so beef, chicken, and coffee. Coffee has been a really big focus as they try to increase the engagement and productivity of their early morning business. So they've had some pretty good success there, at least in North America. And then chicken is one where it's been a lot of competition. Obviously, Chick-fil-A, KFC, businesses like that. Some other foreign businesses coming over into North American markets. So that's been very competitive. And then on beef and burgers, I'd say they've been doing really well, gaining a lot of share. And then doubling down on the 4Ds, they've been calling it for the last few years. So where kind of the quick service restaurant business is going and growing. First one's delivery. They were one of the first restaurants to kind of have an exclusive partnership with Uber Eats. Now they have their own app and they deliver through their app. It's probably like a white label Uber Eats or DoorDash, but nonetheless, they've really invested there and focused there and embraced that part of the business. The second one is digital. So even on their app, you can kind of order on the app, pick up in store, order curbside, do all these different things. They're really a leader on their app and their loyalty points that they have with consumers. Drive through, this I think accelerated more at the beginning of the pandemic, but just having drive through options for consumers who don't want to get out of their car, it's increased convenience. You don't have to go in and interact with people. So that's been one that they've been trying to open more locations and increase the percentage of their locations that have a drive-through window and option for consumers. And then development. So that's really about expanding the network that we talked about on the last slide. In terms of McDonald's real estate, so I'm not sure if you guys have watched the movie The Founder or know more about McDonald's background, but this company owns a ton of real estate, and it's one of the reasons I like owning the stock in the company. I believe they have over $40 billion of assets under real estate on their balance sheet, and lots of that's thought to be understated since it was kind of fair valued a while ago. But they really leverage the real estate by using it to enhance the amount of royalties that they're getting from franchisees. So instead of paying a monthly rent, they charge lots of their franchisees who have a restaurant on McDonald's real estate 10% of revenue or something along those lines. So where they own real estate in like very strong flagship locations, the rent can be really high because it's just a byproduct of how productive that business and that McDonald's is. It also puts them in a very powerful position to make sure franchisees are following the rules. When you're the business's landlord too, it's a lot of like power from the corporation over your business, which is good if you're an owner of the underlying corporation. And I just think it provides like some safety to the valuation and the book value of the company. Owning these assets, knowing that lots of their restaurants, no one's going to be able to kick their tenants out and develop the property or the land. They can kind of do what they want with it. So gives them a bit more control over just their end-to-end business. In terms of returning value to shareholders, this is a chart just showing their outstanding share count over the last 20 years or so. So you'll see even about 10 years ago, this company had over 1 billion shares outstanding. They currently have 730 million. So they've bought back 30% of the company just in the last 8-9 years, which is great for long-term shareholders. One of the things that this highlights and that's great about McDonald's is unlike some businesses who will take some of their excess cash after paying their dividend and doing pet projects or exploring, strategic alternatives that have nothing to do with what investors initially invested in. Businesses like McDonald's are just compounding their shareholder return by keeping it simple, keeping it boring, not doing all these M&A activities or these moonshot investments, and just putting it back into buying back a share of the company for their shareholders. The outstanding shares going down has really helped them accelerate their dividend growth as well. The business has grown organically and naturally, but obviously cutting your share count in half enables you to double your dividend over a long period of time without paying out any excess capital or incremental capital to shareholders. So it's definitely an accelerator of the dividend. And McDonald's has increased their dividend 46 straight years. One of the reasons I love the stock so much. And they're not doing like these little 1 or 2% dividends. They increase their dividend 10% last year. I think the year before that they increased it 7 or 8. So they've been increasing it high single digits over the last 10 years on average. 7% average growth rate of the dividend over the last 10 years. So really strong growth on that front on returning income to shareholders. Okay, going into stock number 5, and I'll try to speed it up a bit here for the sake of time on this video. But stock number 5 I own is Alphabet. And I believe this is the last stock I own that doesn't pay a dividend. So I guess it's worth just going back quick and seeing the companies that I own that don't pay dividends are Airbnb, pretty small investment, Amazon, Meta, and Alphabet. So that's it. So 4 out of 28. And Alphabet's the largest one of them. So while Alphabet doesn't pay a dividend, this company is super profitable, spits out a lot of cash flow, is starting to returning it back to shareholders in share buybacks. And honestly, they probably could start paying a dividend if they wanted to. So it's the style of company that just has a lot of free cash flow. And we'll kind of go through my thoughts on how they allocate their capital a bit over the next couple minutes. So I really love their advertising business. Obviously, Google search is a huge cash cow. And by the nature of the type of business it is, being the world's largest search engine by far, it's such a diversified business because they have all kinds of industries around the world seeking their product and seeking their service to reach their consumers. So this is just an example of, forget about the growth rate. It's a bit of a dated number for each of these business segments, but just all the different industries that invest in Google in a big way. So you can kind of see in a world where X, Y, and Z may be soft, A, B, and C may be growing their spend and trying to increase their businesses. So very well diversified business from a segment perspective. Obviously, ads as a whole trend downwards throughout recessions. So despite that, their margins are so high, and even if ad spend and volumes go down, this is a business that's just poised to be super profitable in any environment. It's just, you'll get a stock hit because the earnings will compress a bit during tough times and really explode during good times. But just overall, I love the fundamentals of the business. They also own YouTube, which I'm very bullish on. Lots of you probably spend lots of time on YouTube. I think they have a lot of awesome creators and incentivizing creators to provide high levels of content on YouTube. So I think that's a great video-backed business that really complements the ad team who's selling Google search. And I think that'll be a much bigger part of the business in the future. One area of the business that they're investing in that I actually think there's promise for is Google Cloud. So Google Cloud revenue continues to go up year over year. You can kind of see quarterly revenues have almost tripled in the last 3 years. And as this has happened, every quarter, the gross margin of the business has gone up. So they're getting closer for this to stop being a bleeder on profit and to hopefully break even soon. I think that's obviously the goal given how the market's really focused on earnings and cutting losses. So they do have their other bets division, which I think has been a bit of a failure of capital allocation over the last 10 years. No real big wins coming out of it other than some of their autonomous driving stuff, but I don't think that's produced any income yet. But if you look at all the money they've lost investing in these businesses, you're probably at about like $100 billion or something. So just think about what you could have bought for shareholders, or how much value you could have created by buying back stock or paying a dividend with that instead of these moonshot type investments. So that's what I mean on the McDonald's front. I love how they just return it all to you. They're not making these gamble bets, but I like how at Alphabet they at least have cloud that is poised to diversify their advertising business down the road. Still early stages, but one that I'm keeping an eye on. And then lastly, just talking about their overall business. So this is a huge business. What I just want to highlight here is just make sure if you're looking at investing in Alphabet, and what I know I'm investing in here is an advertising business. So $60 billion or $69 billion in revenue, or this is probably a better way to look at it. $17 billion in operating income. 20 billion of it is from Google revenue, so search and advertising. And then all the other channels lose money. So Other Bets and Google Cloud both losing 1.6 billion on a quarterly basis. So that's like 5-6 billion a year. And then Google Cloud, while it's improving its gross margin, as revenue is going up, the absolute loss is going up higher. So obviously, as the margin gets better over time, no matter what the revenue growth is, the losses will subside and hopefully turn profitable. So this, at least, I can see line of sight on. The Other Bets division. I just put no value towards. Going into stock number 4 that I own, it is TD Bank. So some of you may not be familiar with TD Bank, but TD Bank is a very large bank in Canada, but also has a very strong presence in the US, specifically on the north of the US and the east side of the US. So largest bank in Canada from a total assets and deposit point of view, but it's the 5th largest North American bank. So huge presence, huge bank, very well diversified across multiple markets, and they're really looking at growing. So they've currently acquired First Horizon Bank, I believe, which is a big bank in the east of the US for about $11-12 billion. It should increase the size of their bank from a top line, assets, deposits, and also bottom line by about 10% automatically next year. It's planning on closing in the first quarter, so any month now, and that'll be a very big and accretive acquisition for the company. But in addition to that, they've also acquired keg.un, not exactly sure how to pronounce it. I've heard it both ways, which is, I believe, like an investment bank services provider out of New York. So it just shows how they're really focusing on growing in America, given they're very highly penetrated in Canada already. If you look at the stock one more time, they're trading at just under $90 a share, and they're going to make about $9.50 of earnings this year. So trading under 10 times earnings. And what's interesting is, like I said, First Horizon will do automatically a 10% bump to EPS even before organic growth. And even if they only have a couple percent of organic growth next year, which I think they're projecting higher than that, EPS will go from like $9.50 to $11. So we're looking at a stock that's trading probably about 8 times earnings for 2023, as long as everything goes according to plan. And it's a really state-of-the-art, very high-quality bank that plays across the US and Canada. Looking at their business mix, so they have a lot of retail banking in Canada and the US, almost 3/4 of their business, which is usually a bit less volatile. They don't have a ton of like capital markets exposure and stuff like that, which is good given the environment we may be going into. They do own a percentage of Charles Schwab, the brokerage, behind their TD Ameritrade equity stake that kind of got rolled into that company. They have a wholesale division, and then they've kind of been piecing together a bit of a wealth management and insurance business over the years. A pretty small part of the overall business, but one that they do have across Canada and the US. So once again, just looking at their highlights, $9.50 in EPS, growing really well, expecting to grow more in 2023 organically, and then add on another 10% for the First Horizon acquisition. So ultimately, I just think this is a bank, tons of track record of having superior performance and providing a lot of growth on revenue, on EPS, on dividends, and is really well positioned for growth right now on a company level, but trading at probably 8 times forward earnings, 9 times trailing earnings. So I just think the Canadian banks and probably the US banks too are just underpriced in the current environment. And that's why this is one that is a top 4 holding for me. I'd consider adding more to it as we kind of see how 2023 plays out. Last thing I just want to share here is this bank has been paying dividends for over 150 years. My shares will probably be paying dividends long after I die. The current dividend, I believe, is about 4.5% because the stock's gone down since this presentation. And even on that 4.5%, it's only about 40% of the company's EPS. So it's a lot more money that they're taking in every month that they're buying back shares with. They're pretty much going to buy First Horizon, which is over $10 billion US in cash. So that just goes to show how well capitalized their balance sheet is, and really puts them into a position to play offense in terms of creating growth through M&A, but also invest internally where opportunities come up. Okay, so going into the top three, the number 3 stock I own is Procter & Gamble. So P&G, very similar sound bites to McDonald's. Big company, global presence, brands that we know, and relatively defensive business overall, but trading pretty rich. So this is one that, similar to McDonald's, isn't one that I think has a ton of upside here, but I'm comfortable with it being almost 10% of my portfolio. It may underperform the market in the next year, but over the next 10, 20 years with the compound dividend growth, then buying back shares, I believe that this stock will do just fine, and I sleep well at night owning it in my portfolio. A bit more about the company. So they've gone through a bit of a brand consolidation process over the last number of years where they've really focused on 10 categories that are daily use categories they think have a lot of growth ahead of them. And they divested lots of the more complex businesses that have much different drivers and are maybe a bit more commoditized and stuff like that, to really focus on businesses that have a lot of volume flowing into them, but also have healthy economics and structures. They just reported their earnings this week. So the company is kind of starting to see the impact from taking a lot of pricing to combat inflation and costs going up. So we've seen the total company about flat on net sales. The one thing I'll mention is I think they had almost a 10% impact from FX. So this is obviously an American company that plays very heavily abroad. So lots of these numbers are actually a lot better on an organic basis, or a core basis rather. But when you add in the FX impact, they just weren't able to keep up with all of that as a headwind. And we're seeing that on lots of these big multinational companies. But overall, holding up pretty well given the FX environment, and all the pricing that needs to be taken to hold gross margins in a steady spot. And about a $330 billion company made $4 billion in net income on the quarter in US dollars. So you can see, like, even if you 80-20 multiply that by 4 companies returning 4 or 5% on earnings on the value of the company. So richly valued, but they're pretty safe earnings, all things considered, and that's why the company is trading where it is. One of the things I love about the company, 66 years of dividend increases, similar to McDonald's. Lately, they've been actually increasing the dividend significantly. So 2 years ago was 10%, last year was 5%. We're really seeing that acceleration of capital being returned to shareholders. They also do the same thing as McDonald's on share buybacks. I think they've bought back 4 or 5% of the company over the last 2 years. So I love to see that as well over the long term. That's just a great formula to create a lot of shareholder value. Stock number 2, Riocan. So Riocan, for those of you who may not be aware, is a Canadian commercial real estate REIT. They play primarily in retail, but they do have kind of small segments of their business in residential, which they've been trying to build out a bit more, and then also office through multi-use properties. Riocan stock has kind of gone all over the place, similar to First Capital and Allied, which we talked the other day. I believe their net asset value is in the mid to high 20s, maybe $26, $27. So I think it's less of a delta here than we saw on some of those names, but still trading probably 10 to 20% below fair value of their real estate. And this stock just got hammered during COVID, has finally kind of clawed its way back up into the 20s. But throughout it, they continue to pay a dividend, currently paying about 4.5%. They did cut the dividend, not because they couldn't pay the old dividend, but because they wanted to adjust the um, business model to keep more capital in the business to really fuel growth and fuel their development pipeline. So we'll talk about that in a minute too. But I just wanted to kind of comment on this because this is also a common theme that we've seen on lots of the REITs I own, Allied, First Capital, now Riocan. Lots of these businesses are really focusing on major cities as Canada continues to grow primarily through immigration, which flows to these big cities. So lots of the growth in Canada from a population density standpoint is coming from the big cities, and these REITs want to be positioned to capitalize on that growth and the rent increases that will come with that growth. And that's why you're seeing here Riocan repositioning their portfolio over the last 5 years to go from 3/4 in the big cities to over 90% in the big cities. Once again, their development pipelines really what they're focused on to fuel their growth over the next number of years. So this company is not really looking at doing a lot of strategic big acquisitions. They're using all of their free cash flow after they pay their dividend to fuel some of these developments. And then once these developments goes live, they turn into cash providers instead of cash suckers in terms of capital deployment. And that will just fuel opportunities to increase the dividend, buy back shares, do more M&A, stuff like that down the road. So I think their development pipeline's pretty rich for 2023 and first half of 2024. And then I think it slows down a bit more. So we may see after mid next year a lot more capital flowing to the bottom line, and they'll make some hopefully shareholder accretive decisions with what to do with that capital. And this was just what I was alluding to a couple minutes ago, where they kind of adjusted their dividend downwards from 12 cents a share to 8 or 8.5. And it kind of came with the forecast that if we're able to keep a couple percent more in the company, we can really invest it on those developments to fuel fund from operations growth, which will maximize total shareholder return over the long period of time. So we're kind of waiting and seeing if that actually actualizes. So let's hope so. Now, this is just to show you kind of the quality of these assets. Once again, similar to First Capital, Allied, these REITs don't own many crappy shopping malls in the middle of nowhere. They're really focusing on premiumizing their portfolios and owning hero flagship assets that really can't be replaced 10, 20 years down the line. So just want to show you guys a couple images to show you the quality of REITs like this. So right here is their biggest project that they have. I think it's valued at over like $1 billion. So it will be a huge part of the company once it goes live. But it's like 6 or 7 towers, includes residential, rental buildings, office buildings, retail space all over the bottom, right into downtown of Toronto. So that's obviously one that is a huge focus, and they talk about on the earnings calls of the company. I believe they own like 30 to 40% of this. They also share this with Allied, who's a co-owner, and I also own that company, and a private company as well. Another one here, right downtown Toronto, they're looking at building 2 huge towers that are going to be rental buildings, luxury rental buildings, as well as office, as well as retail on the bottom. So they're really densifying their assets in downtown locations to provide more square footage on the same land. And then here's just an example of one of the many projects they have as they build residential buildings. So this, I believe, specifically is a rental building, 91% leased. The other one's 97% leased. And this just shows how they're really jumping into the residential renting space. So I believe it's currently only about 3.5% of the company's profits, but I know they have aspirations to grow this a bit more. It's never going to be a big part of the company, but I think it could get up to 5 to 10%, which is a nice little piece of diversification because these retail REITs trade at about 12, 13 times earnings, but typically the apartment REITs in Canada trade at about 20 times earnings currently. So this is more valuable earnings to investors, and I think they're trying to use some exposure here to increase their multiple of their stock and get them closer to what net asset value they feel like they should be trading at. In terms of valuation on this one, just before moving on, I believe they're going to do about $1.70 in funds from operation this year, trading at about $22. So we're talking about 13 and a half times earnings, let's call it. So that's about a 6-7% return. 4.5% of that gets paid out in a dividend. The other 2% is either share buybacks or fueling the development pipeline farther over forecast. And that's kind of how they redeploy capital to create value long term for the shareholder. And my number one holding that I own in my portfolio is CN Railway. So this is a big company that operates both in Canada and the US. Lots of people who know the railway industry in the US or Canada know this company. And it is by far my number one holding at a huge 12% of my overall portfolio. So this stock over the last year and really over the last 5 years has held up very well, up 7% despite the market being down 20. Also got a couple percent dividend. So similar to some of the other stocks I've shared here, has really delivered almost a 10% return in an environment where the market's down 10 to 20%. So can't really complain with the performance of the company. The company 2 years ago did about $6 of EPS. This year they're on pace for $7, and I think next year they're going to probably do $7.50 to $8. So this is, $6 2 years ago, $7 in 2021, and then this year they're going to do 2022, which they're reporting next week, should do probably about $8. So growing about 20% year over year on earnings, really, really impressive. Driving a lot of free cash flow growth, high return on investments, buying back lots of share, increasing the dividend. You kind of get the model here of the type of stocks I like putting lots of money into and giving large positions. Just companies that I know aren't going to go rogue and invest in moonshot projects for the most part, with Google being the exception, but that are buying back their shares, increasing their dividend consistently, safe businesses, large moats. No one's going to build another railway, especially in the areas that CN currently operates in. So I really like this business. I think it's positioned really strongly. Just looking at where they get lots of their revenue from, you can kind of see very diversified. So metals, forest products, petroleum, intermodal, coal, automotive. And as the economy develops and continues to change and grow, this shift grows accordingly. And as new industries emerge, they kind of pivot their resources and the services they provide in order to assist the changes in the economy. So it's only one railway, or only a couple of railways in Canada, only like 6 or 7 ones at this scale in North America, and there's never going to be any more. So they are positioned really well to continue to serve the economy, no matter what that economy looks like 10, 20, 30 years from now. In terms of their network, you can kind of see here a bit of a legend here, but where it's the thickest, that's where the most volume gets put on. But essentially, this is a railway that goes from coast to coast in Canada. They have ports all over both of the coasts. They also go down all the way through the US. So just strategically positioned very well, where it's hitting 3 coasts of North America, can move all kinds of products to all kinds of places. They also own trucking businesses that can stop at certain ports on the coast from other countries and move volume to the track network, or from the track network to the coast. So they're just a huge logistics company that's operating in the best economy in the world, and that's why I love this business. Just an idea of like the type of assets they own and how like irreplaceable these assets are and the true mode of the company. This is one example of just some assets that they own on the west side of Canada, very west end of Canada, that they bring a lot of goods to and from Asia and Europe. It just kind of shows the value, or sorry, not Europe, but Asia. It just kind of shows how rare these assets are, and how no one's really going to be able to compete to a great extent with them, given the uniqueness of these types of assets. So this is a project there investing in right now, some capex in. And this is really just building out on the coast of British Columbia, rather, just all these different types of plants and facilities to hold oil and provide all these other services to people that are shipping products in, shipping products out. And if you need to ship energy or something else out of the west end of North America over to China or over to other countries in Asia, there really isn't a bunch of businesses that are providing these services. You really kind of have to go to these companies, and they're innovating and providing new services that they know that their customers need today, that they can just expand their book of business with these current customers and get more share of wallet, and also just accelerate the amount of trade that's coming in and out by providing some of these facilities and things that make doing business overseas easier. So this is just one example of a project. They have all kinds of projects and opportunities to invest in the business, not just on the railway is what I want to get across here. They also own a bunch of ports and other types of business that help facilitate trade and commerce. On returning capital to shareholders, you can see here annual dividend since they went public in the mid-90s has increased year over year very fluidly. And right now, it's really been ramping up over the last 5 years. So paying out about $3 per share. They raise the dividend every January, I believe. So I expect this to go up another 5 to 10% at least. Last year, it went up 15%. And then this company's worth about $100 billion. They've bought back $25 billion in the last 20 years. So once again, having a long-term horizon on a business like this, it's really hard to compete with them in a meaningful way that's going to destroy their economics, given the nature of the business and the moat they have. They are a boring business. They provide services that facilitate trade and movement around the North America economy, as well as imports and exports out of the country. None of this is really going to change in the near to medium term. And they give all that capital back to shareholders after they invest in high return on investment projects through dividends and buybacks. So over 10 years, I have no question that the stock's going to be worth more money than it is today. And along the way, I'm getting that increased dividend paid to me. So this is a business that I'll probably hold till I die, and that I love being a shareholder of. Looking at just 2022 outlook, so this is a bit dated. They'll report these numbers next week, but you can kind of see the growth and the return on invested capital that they're expecting. I expect them to probably come in line with these numbers. And then just before signing off here, I just wanted to go through my entire portfolio in one go. So once again, only a couple stocks that don't pay dividends. I'm really a dividend investor at the core of my portfolio, taking all those dividends, redeploying them in areas of my portfolio. I think that we have opportunity and that are undervalued, and I can do more videos on where I think that is. But I really prefer that model versus letting the companies decide what to do with excess capital. I think I've just seen so many examples of that equating to destroyed value. Just looking at the screen here, obviously Meta's the example that jumps out like a sore thumb. If you give a founder with controlling shares of the company too much free cash flow to play around with, they'll find a way to waste it. And then Google, to a lesser extent, with like other bets, the shareholder would be way better served if Google just paid that money out as a small dividend 10 years ago and build it from there, rather than investing in pet projects that don't have line of sight to profitability. So I just prefer the businesses that do what they do, return the capital to shareholders, and let us decide how we'd like to invest it or spend it by either growing our share of that company, growing our share of another company, or paying bills with it. So this is my overall portfolio. Thank you guys so much for watching this video, especially if you've watched the other videos too. A lot of work went into putting these together. So if you like this type of content, please subscribe to the channel. Please let me know what stocks here you like, you don't like, especially any of the stocks in the top 6. If you have a bear case on any of them, trust me, I'd love to know, given how much of my portfolio are in them. I'd love to hear your opinion. But without anything else to say here, I'll see you guys in the next one.